Hello, and welcome to the Three Questions podcast, where we dive deep into the world of wealth management and connect you with industry experts. I'm your host, Wayne Baxter, Senior Executive Manager at One Capital Management. Are you or someone close to you a U.S., Canadian dual citizen, a resident alien, or a citizen of one country living and working in the other country? If so, you're not going to want to miss today's episode of the Three Questions podcast. We're going to address the three questions cross-border investors should ask about dual citizenship and tax residency. Thank you for taking time to check us out. And if you enjoy this episode of the Three Questions podcast, please consider liking this video and subscribing to our podcast and YouTube channels. Our special guest today is Marc Gedeon. Marc is the founder and principal at Gedeon Law and CPA. Marc and his team specialize in cross-border taxation matters with an emphasis on tax preparation and planning for clients who work, invest, and conduct business in the United States and Canada. Marc, great to see you. Welcome to the podcast. And it's about time we had you back.
Thanks for having me back. I'm looking forward to our discussion.
Well, a lot to go over today. We're going to do a three-part series on taxation for cross-border clients. So looking forward to our conversation. Over the past years, we've collaborated on many cross-border cases, and I'm sure our audience are going to be very excited to learn more about cross-border tax planning from you, Marc. And again, really great to have you here. We're going to address today the three questions cross-border investors should ask about dual citizenship and tax residency. And if there was ever an area, and I'm sure Marc's going to agree with this, if there's ever an area where it's essential to seek guidance from a qualified professional, it is cross-border tax planning. I'm sure, Marc, you would agree.
Absolutely.
For sure. We want to definitely this is not a do-it-yourself a software type of planning strategy that you want to take advantage of. I think the key thing about cross-border tax planning is, the strategies that go behind it, the fact that you're dealing with tax regimes in both Canada and the US. And it's really important that, again, we work together, collaborating, yourself, your financial advisors. It is an ongoing process as well. So for a U.S. Canadian dual citizen, a resident alien, or a citizen of one country living, working in the other country, there are several critical tax planning questions to consider. So today's topic, three questions cross-border investors should ask about dual citizenship and tax residency. And Marc, let's get right into the questions. We got a lot to go over here today. Question number one, how does the U.S. and Canada define tax residency? And I got a follow-up question beyond that one, but we'll start with that. How do the U.S. and Canada define tax residency?
Right. Well, let's start with the U.S. side first. So obviously, if you're a U.S. citizen, you're also a U.S. taxpayer. Then there's also a green card holder. If you've got a green card, you're also going to be considered a U.S. Person and U.S. tax resident. The one that tends to be more subjective, I guess, is the what they call the substantial presence test, and that's where the U.S. tax system can deem you to be a U.S. resident just based on the number of days you're physically present in the United States, and that can affect anybody from somebody who comes to the U.S. for business travel or for being a snowbird. Or even just, coming to visit family. It's subjective, but it's also objective, because obviously it's simple to track your travel history. And a lot of people, you can pull that information even from USCIS nowadays. Or even from your travel miles or
your itinerary, just checking your flights in and out of the U.S. or travel.
Yeah. So that's in a way that's objective. Now, where it can be subjective is when you've got a situation where you're still considered a resident of Canada, for example, but you're also considered a U.S. tax resident under the substantial presence test. That's when you have to look to the treaty, and it becomes more of a subjective analysis to look at different factors as far as what where your ties are closest, right? Do you have stronger ties to Canada, or are your ties obviously closer to the US? So that's how the US system operates. And this is one of the areas that I always like to plan in advance with clients, before they decide to say move to the US, is to look at what immigration path they're coming through, be it that they might be citizens or green cards or even a visa. Um, and we also like to plan ahead and for timing purposes as well, because at times you want to coordinate everything where your exit from Canada is timed at a certain time based on certain factors in your life, and your U.S. tax residency is going to start as well. And this affects people even if they're coming to the U.S. for marriage, for work, for school. Believe it or not, students also are impacted by this. So yeah, it's something we want to look at and analyze before making the move.
And
Um,
I think it should also be important to note here, just on this point, it's people who can have work visas that are like temporary TN visas, where they're not officially deemed a permanent resident of the U.S., but they're still subject to U.S. taxes. Like if you're on a TN visa, for example, and you're working in the
Correct.
U.S. for an extended period of time, usually TN visas run for about 3 years. Now, as I understand it, and I'm not an immigration attorney, but you are effectively not a permanent resident of the United States, but you're working in the United States. So you're going to be subject to U.S. taxes.
Yeah, and one thing I try to stress to people, and I think most people are surprised by this, the tax system and the immigration system operate completely separately.
Absolutely.
They're mutually exclusive, and the laws for one don't have any real bearing on how the laws are applied for the other. So yeah, TN visa may say you're not able to have permanent intent to live in the US and so
But you're
forth,
still
but
subject to U.S. taxation.
exactly, right, even
And
though you're
and another one that you and I are familiar with is, like we could go really down some rabbit holes here on this conversation. I know we're going to, but you got to be careful not to, with that TN visa, that that doesn't permit you to stay in the U.S. after you've retired. I know a case of people who worked in the U.S. for decades, and then, well, I've contributed to Social Security. I've definitely got I qualify for Social Security, but on a TN visa, that doesn't qualify for permanent residency. So that's a crossover to an immigration discussion. To your point, just one follow-up question, Mark. And this is sort of a question that I get asked, and that is, can I be considered a tax resident in both countries simultaneously?
Yeah, definitely. I mean, let's go back to the first question, because I never did touch on this. And your question was, well, what about how am I considered a tax resident in
Right.
Canada? So Canada doesn't have a citizenship-based tax residency like the US does. So
Okay.
really on the Canadian side, it's really going to come down to obviously the number of days you spend in Canada. So generally 6 months or more. And they look at your primary and secondary ties to Canada, and mainly the primary ties. And by primary ties, your home, family, personal belongings. A lot of people, when they call me and talk to me, they're like, "Oh, I still have a credit card in Canada, or I still have a bank account in Canada." Those are really not primary ties. Those are periphery ties. Okay, find me a Canadian that doesn't live in Canada, then and doesn't have, still have a Canadian bank account, right? So it's and they haven't been Canadian residents for ages. So it's not enough to just say, well, I've got a Canadian bank account, therefore I've got ties to Canada. It's more than that. It's going to come down to homes, family, um, you know, intent, even like where do you intend to call your home? Where do you maintain social ties and business ties and so forth? So you could argue that the Canadian system is also subjective as well, similar to the US side when you're dealing with the substantial presence test. Now, to go back to your question about can I be a tax resident in both countries? Absolutely. Because what if you're a US citizen and you live in Canada full time? Well, you gotta be US, you're a US taxpayer, you're also gonna be a Canadian tax resident. So now that one's probably more clear cut, but I think the ones where people have uncertainty is if you're, for example, somebody who's taking a job in the US. You know, you get hired in the US, you're leaving Canada. Maybe you've got a home you're gonna leave behind, a condo in Toronto, or your family is gonna stay behind, or you may just be single and you're like, well, no, I'm packing up, I'm leaving. These are the kind of situations where we do go through the analysis to look at, have you, severed your ties? Have you given up your residency in say, Canada and now become a resident in the US? And part of doing that, we have to look at the treaty. And we have to look at the factors that the treaty looks at when it comes to deciding where are you a resident? Because to go back to your question, can I be a resident of both countries? Yeah. And at the same time, that's where the treaty will come in and make it and basically break the tie to determine what country you will default to as a resident. And it can be pretty tricky to because you might be somebody, you've got a home in the US, a home in Canada, and you spend time in both countries. And so at the end of the day, one of the real deciding factors when you look at the treaty will be citizenship. And so, for example, if you're really somebody who's considered to be a tax resident of both the US and Canada, and you can't really make a decision which one you have closer ties to, then the default's going to be citizenship. So if you're a Canadian citizen only, then you're going to end up becoming a Canadian resident. So
It gets really fun though if you're a dual citizen.
yeah, and
Then
exactly.
what?
Well, then there's a special competent authority that handles these cases. But ultimately, I'll tell you this: one thing about the Canadian side generally is if you're a citizen or a green card holder and you are living in the US, chances are Canada is going to treat you as a non-resident. Usually those ties are pretty strong to show that you love Canada, provided, other factors or mitigate your situation of being a resident in Canada.
Okay, Mark, thank you. Very detailed answer to question number one. We're going to move on to question number two. If I decide to relinquish my citizenship or residency in one country, what are the tax implications? And this including exit taxes or other charges, right? And basically, comparing, one to the other, Canada to the US. So if we decide to relinquish our citizenship to what country or tax residency, what are the tax implications?
Right. Probably start with the Canadian side. So in Canada, for the Canadian side, you're relinquishing citizenship isn't really an issue when it comes to taxes, because Canada doesn't tax you based on citizenship. That's more of an issue when you're a U.S. citizen. On the Canadian side, however, when you do leave Canada, okay, and the way that the Canadian system operates for somebody who leaves Canada is different than somebody who's leaving the U.S., especially if you've been living in the U.S. for a long time as a green card holder, and we'll get to that shortly. But with Canada, you're subject to a deemed disposition at the time you leave. Similar to how the Canadian system operates when you die. There's a deemed disposition of your assets at the time of death, and you're considered to have paid tax at the time of death or have income at time of death related to the assets you've owned. Same thing happens at the time you exit Canada. Now, this is where really there's the need for advanced planning. And when I mean advanced planning, it doesn't have to be complex. It just what I mean by that is time. Time is your friend. Whenever you want to make a move between countries, time is your friend, because so many factors, so many variables and moving parts that need to be addressed and analyzed to really effectively plan a tax move from one country to the other. So obviously, the more time you have to plan, the better the outcome will be. So, you know, with Canadians who are looking to leave Canada, which is very, very common, especially in today's economy and for the last many, many years. I think going even back to the days of the original brain drain back in like even the 70s. You know, there's things that can cause you complications when it comes to leaving Canada, and that's, for example, if you own shares of Canadian companies, you own a Canadian trust or you're a beneficiary or a settler of a Canadian trust. So there's a bunch of complexities. The less complicated issues are going to be, believe it or not, Canadian real estate, investments, where someone like yourself will work with somebody who's looking to move to guide them on how to properly prepare for their departure with their with regards to their investments. That's the Canadian side. So it's pretty clear cut as far as what needs to be addressed. The U.S. side, on the other hand, yeah, that's more complicated, especially if you are somebody that's giving up your citizenship.
Or a green card even, like that's where it gets really interesting too, between
Right.
green card citizenship and remember we were talking earlier about the TN visa. The outcomes are different depending on what your status is when you decide.
Correct. Correct. And not every green card holder is going to have to go through what's called the covered expatriate
Right,
process. That's basically the same as if you're giving up your citizenship, and that's going to apply to somebody who's held a green card for more than 8 years
right,
generally, and has a certain net worth of $2 million US or more,
right.
or has high taxable income as well. There's a few factors that can cause you to be considered a covered expatriate, and there are some things we can do for people that say are on a green card and they are approaching, let's say, that 8-year mark. Although it's preferable to start the planning and start the analysis as you're approaching your the 6-year mark, as opposed to waiting 8 years. But there are things that can be done to avoid being caught up in the covered expatriate type rules. And just to go back, the covered expatriate rules, as well as giving up your citizenship, are going to apply to people similar to Canada, where you're going to have to do an exit tax. You're going to have a deemed disposition of assets, and you're going to be subject to like a departure tax on the U.S. side. And some people might not realize this, but this can affect things like tax on your retirement accounts in the U.S., capital gains on homes that you have.
Or
So
money or liquid assets that you have in your revocable trust as well.
correct, all sorts of things can get caught up in this expatriate
Because they're
tax.
evaluating your entire net worth. We're talking about the green card holder there. They evaluate your entire net worth, not just liquid assets.
Yeah. So
I want to ask you a question, going back to the exit tax from Canada. Is that, just to clarify, because I get this question asked more than once, is that exit tax on the asset, or is it on the gain that the asset has incurred?
the gain.
All right. So tax-free savings accounts in Canada. You're a resident of Canada. TFSA is a tax sheltered asset. So it would mainly be your non-registered investments that would be the one that would be the most exposed,
Correct.
versus the TFSA versus RSPs versus
Correct.
LIRAs, RIFs, et cetera, et cetera.
Correct. Correct, exactly.
And also your principal residence wouldn't be opposed, it would be your, if you have a cottage or secondary
No,
properties,
yeah, no Canadian real estate is subject to the exit tax because,
even if you're selling, interesting.
yeah, well,
So
because what will happen is when you do eventually sell the property, even
there's
as a
capital
non-resident,
gains.
that's when the Canadian government will
Get
require
their
you,
pound of flesh.
they're going to make you go through a process called the certificate of compliance. And that's what, yeah, that's where they get their pound of flesh. But one thing to keep in mind is there are ways to make an election at the time you leave Canada to do a deemed disposition of your home so that you may crystallize any gain, potentially any tax-free gain at the time you leave, so that down the road you may not have to pay any tax in Canada on a portion of the gain, or also on the US side as well, on the appreciation up to
Yeah,
the time.
because once you become a US resident, that tax sheltered asset, otherwise known as your principal residence in Canada, is no more.
Yeah, so there's a formula that they'll apply based on how long you've owned the house, how long you've lived in the house. So yeah, this is the stuff where, again, talk to somebody like myself who's been through hundreds of these scenarios and so many different variables that, you know, we can analyze it, we can figure out what would be the best path, what's the best course of action to, you know, plan for your departure, be it via real estate, your investments, your company, other assets you may own, even a car collection, believe it or not. There's
We have a case that we've worked on where that's actually applicable. So
Yeah.
yes.
So, classic car collection also could be subject to all this.
I want to turn our direction on the third question to estate and inheritance taxes. So question number 3, how do estate and inheritance taxes apply to assets held in each country, considering dual citizenship or the residency status? So, state assets, inheritance, how are they addressed from the perspective of the dual citizen or person living in a citizen of one country working in the other?
Yeah, so I'll preface what I'm about to say with, I'm not an estate lawyer and I don't,
Fair, you don't play one on TV either, right?
yeah, yeah. So I don't, I'm not the best person I mean, I know enough to be dangerous, but by no means am I somebody who deals with estate tax issues on a regular basis. But for most of my clients, right, we'll be in a situation where, perfect example is, the children have moved to the US, they're living in the US, they've got families, they're working, etc. And they've got parents back in Canada that want to gift them assets. And I've got recently we're working on a case where somebody lives in the US, and the parents back home in Toronto own commercial properties that are worth a lot of money, and they want to leave that to their children, but one of the children lives in the US. And so there are going to be complications. And one of the things on the US side is, generally when you do receive a foreign inheritance and it's above $100,000 US, you do have to report it.
Mm-hmm.
Not necessarily that it's not taxable.
You just have to acknowledge that you received it.
Correct. And you have to describe what it is, how much it's worth, all sorts of stuff. And so for people that live in the US, I think it's not so much tax issues that you're going to be dealing with via receiving the inheritance, but it's more going to be what happens based on the type of property that you inherit. Could it be, if it's Canadian real estate, or if it's shares in a Canadian company, or trying to think of some other examples of things people inherit. Usually it's cash. Cash is always the easiest by far. You're going to
But you
inherit
still have
anything.
to report it. And
Yeah.
I'll tell you, I've had cases, and we probably a topic for another program, of people thinking, well, if I just leave it in a bank account in Canada, the IRS won't know about it. au contraire, right? We all
Mm,
know that's a huge,
yeah. Oh, and a lot of the Canadian banks now are very diligent in terms of capturing anybody who's got ties to the US and flagging their accounts.
and the
And
penalties for not reporting can be incredible. So,
yeah, so um, now Canada, not doesn't necessarily have the same rules when it comes to receiving foreign inheritances like the US does. But again, on the Canadian side, you could be dealing, well, there is one thing on the Canadian side you got to be careful about, and that's when you inherit from what's considered to be a Canadian or a living trust in America, for example. Let's take
right,
a California living trust, for example, or a revocable trust. Very common estate planning vehicles in states that have probate.
right.
And most, if you own a house in the US, you almost guaranteed want to have a living trust in place just for that house alone. So
I concur.
so the problem is, from a US tax standpoint, these living trusts are basically just disregarded. They're not really something subject to any sort of special tax treatment. They're more just designed for probate purposes.
Hmm.
Canada, on the other hand, takes a whole different approach when it comes to living trusts. And so, whereas somebody receives a distribution in America from a living trust and it's completely tax free, that same distribution that goes to somebody in Canada is that could be subject to Canadian tax now, even though it's an inheritance. It should be tax free. So there's things you need to put in place in order to, well, obviously the best thing is avoid naming beneficiaries of a Canadian of a California living trust, for example, somebody who lives in Canada. But there's also other things that would have to be done with trustees to ensure that distributions from the trust are handled a certain way so as
Right.
not to trigger any
You don't want to
Canadian.
have a, you don't want to have a, you don't want to have a US a revocable trust with a Canadian trustee. That's a major problem. I
Well,
know that.
that's also, and vice versa. You don't want to
That's
have a Canadian probate or estate that's also administered by a US resident, because that creates problems on the Canadian side
right.
potentially.
You want to keep,
So,
you can have powers of attorney in the other country, but you don't want to have executors or trustees in the other country. I know that's a,
yeah. So
you're up
it's
against a hornet's nest on that one. Lots to
it's
cover. You know what, Mark?
complicated.
This, like I said, I knew when we were going to have this conversation today, it was going to be pretty technical, relatively speaking, which is great. We want to educate and inform our audience here, and I think we've done a great job. We've only really kind of scratched the surface here on this topic of cross-border tax planning. But before we close, I just want to ask one additional favor of you, and that is, can you provide our audience of the just an overview, high level, 36,000 feet in the air, of the requirements for reporting foreign assets? We talked a little bit about it, foreign bank accounts, like investments, like specifically if you're as a U.S. tax person, just bring to light what is required. Because again, like I mentioned to you earlier, a case that was referred to me a few months ago of an individual who had all of their money still they were living in the US, working in the US, but they received an inheritance and they left it in a Canadian bank account and thought that they just left the money there, that they wouldn't have to report. So maybe just talk a little bit about the responsibilities, especially of a Canadian living here in the US or that has to report to the IRS what their obligations are.
Yeah, so there's a lot of reporting actually when you own foreign assets. Um, so I mean, bank accounts, investment accounts, RSPs, these are all pretty straightforward. I mean, there's something called the FBAR that you disclose details about your bank account and the highest value in the account. And then there's something called an 8938, which is basically the same version, similar to the FBAR, a lot of the same information. There's some added information that's provided, but the difference is who they're filed with. The 8938 is filed with the IRS. The FBARs are filed with an agency called FinCEN. So that's your generic foreign asset reporting that covers most of the foreign assets that people will have outside of the country, be it bank accounts, investment accounts, retirement accounts. But, America doesn't stop there. There's also a lot of other foreign compliance type of reporting that needs to be done, whether it's you own a foreign trust, so a trust in Canada, an interest in foreign companies in Canada, for example, partnerships even. So there's a lot of things. I would say pretty much everything people tend to own in Canada will need to be reported in one shape or form to the IRS. So,
I would also add one more thing. I just thought of it while you were talking is that if you're a Canadian with a US corporation like an LLC, you now have to deal with the Corporate Transparency Act, don't you? As well, isn't
yes, that's also come into effect now. And, a lot of these governments are sharing information now. That's the whole purpose of what these rules
Well,
are
the
looking
Corporate Transparency Act, that's another FinCEN regulation. So to your point.
for. Right. Right, and that's so that they can share information, they want to know what assets you own in each country, and that's happening with your bank accounts. I mean, I get a lot of clients sending me emails saying, oh, I got a BMO send me a letter. They want my US social security number. You
Yeah.
what do I do? And they want to know, do I am I a US resident? So there's all sorts of stuff like this going on. And you're pretty much, going to have to deal with it. Now, the Canadian side has their own version of these sort of compliance reporting, and Canadian side is a little different. It's it's kind of tries to be like the U.S. side, but it's got a lot of things that are, if you ask me, nonsensical as far as the information gathering they're looking to do. But you also, if you do live in Canada and you're a U.S. citizen, or even not a U.S. citizen, just a Canadian, um, and you've got rental property in the U.S., or you've got investment accounts in the U.S. or bank accounts, you're also going to be subject to reporting information to the CRA. Even, and this is the surprising part, even if you're Canadian only, but you work with an investment advisor in Canada exclusively, you have no ties whatsoever to the U.S., but they happen to own investments that are stocks of foreign companies, whether it's in the UK or the US, they also want you to report that as well. So, anytime you've got any foreign investments or assets, each country is going to want you to report something.
Well, I'll tell you right now, what you've just done is just re-emphasize the importance of getting tax advice, especially if you're a cross-border investor, living either in the US or Canada, but have, liquid assets in, the other country or both countries, earning income from the other country from where you were a citizen of originally. You don't want to try to do it yourself in this area. So I really thank you for coming today and joining me, Marc. And for those interested,
let me add one thing for
okay,
those
good.
for people that are still watching. Don't just look for tax advice. Look for practical tax advice. Okay, there's a
Right.
difference, believe me, and that's what you want to seek, because that's what's going to result in you know, having a better outcome when it comes to your tax strategy.
Being pragmatic.
Right.
So for those who are watching and listening, Marc, what is the best way for them to reach you? If they want to say, well, I need to talk to this guy, how can they best connect with you?
Right. Best way to connect with us is to contact us either through our website or by calling us and setting up a consultation. And I can tell you, like, I've been doing this a long time. Even a 30-minute consultation, I can pretty much spot a lot of the issues you're going to deal with. And the key is starting with issues, identifying the issues that you're dealing with. Okay. And we can do that with a consultation. And from there, we can tell you kind of what direction you should be looking at, what we think you should be doing. you know, I've been doing this long enough that I've pretty much dealt with every scenario out there. And, you know, I already know kind of what options or what strategies are available. So definitely start with a consultation, and we can then guide you from there as far as
So
what to do.
the email address is info@gedeonlawcpa.com.
That's correct.
And the website, surprise, surprise, is www.gedeonlawcpa.com.
Correct.
And is there like a 1-800 number that someone could call?
Sure. There's a 888 number. It's 888-473-7967. And if you give us a call,
Perfect.
we can also help you that way as well.
Marc, I want to thank you again for joining us. Our special guest today is Marc Gedeon. He is the founder and principal of Gedeon Law and CPA. An awesome guest. Marc, thanks a lot for coming today and joining us.
Thank you for having me.
I look forward to bringing you the 3 Questions podcast, and I hope you find them educational and informative. Please consider liking this video and subscribing to our podcast and YouTube channels. And to receive notification as to when our latest podcast has been posted, please click on the notifications bell. Lastly, to schedule an online Zoom consultation with me to discuss your wealth management needs, please click on the link in the description box below, www.onecapital.com/meet with Wayne. Thank you, and we'll see you soon.